Most traders lose money not because their strategy is bad, but because they enter when the market is already moved too much. Today, in this video, brought to you by CoinLinity, I will show you how I use the ADR, which stands for the average daily range, to know when to enter, when not to trade, and how to set a realistic profit target. And CoinLinity is a leading online edtech company dedicated to regionalizing financial education. Our mission is to make finance accessible and understandable for all, regardless of background or experience. Through comprehensive courses on forex, stocks, investing, money management, and financial planning, we empower our clients with the knowledge and confidence to navigate the financial world with ease. In this video, we are going to be taking a deeper dive into the average daily range, which is the ADR. We are going to be looking at how we can, incorporate this into our trading activities. But before we dive into this topic, we need you to take a little bit of time to like, subscribe to this channel, and also hit the notification button so they can get notified whenever we upload new educational contents. Do remember that you can also earn reward prizes like cash rewards, trading bonuses, personalized trading plan consultation with a mentor, and so on by engaging with our educational content. So the more you engage with our educational content, the more you can earn reward prizes. So to learn more about our rewards program, you can click on the link below in the description area. So what is ADR? ADR stands for average daily range. It simply tells you how many pips a currency pair usually moves in one day. For example, if Euro USD ADR is 80 pips, that means on average, from high to low, Euro USD moves about 80 pips per day. Now, here's the mistake most traders make. They buy or sell after price has already moved most of the day's range. Then they wonder why price stalls or reverses on them. ADR helps you to avoid chasing late entries. It helps you to avoid unrealistic take profits levels, and also it helps you avoid overtrading exhausted markets. Now, how do you use the average daily range? Number one is to check the ADR value, and number two is to measure today's movement. Now, let's say the ADR of a particular currency pair you are trading is 100 pips. Now, you measure how much price has already moved for that particular day you are trading. If the price has already moved, let's say 70 to 90% of the ADR, be very careful entering new trades on that particular asset or currency pair. The best setups happen only when 30 to 50% of the ADR of that currency asset or currency pair has been used, and price is at a key level, like a support or resistance level. So moving on, we are going to be looking at the ADR on a price chart. We're going to be using the ADR to measure, to look at a practical example, measuring the ADR of different currency pair, especially the Euro USD currency pair. We are going to be looking at an example of an ADR on a particular day on the Euro USD price charts. So over here we have the Euro USD price chart. Now this is the 1 hour time frame on the Euro USD price chart, and these lines you can see here, these green lines here, are the ADR. This is the ADR indicator. Now to get this indicator, what you need to do is to search for average daily. You can see mine here, ASFX ADR2. So you can search for this and put it on your chart, then it will display the ADR lines for you. So I'm going to be using this particular Tuesday because I actually took this trade on Tuesday. Now coming into this particular day, what do we see here? So this is the ADR low and this is the ADR high. And also it will also map out or give you a particular figure, that is the amount of pips that this can move in a day. So as you can see here for this particular day, because let's mark out 12 midnight on that particular. So this is 12 midnight here, right? This is where the new day starts. Sorry, this is around here. This is where the new day starts here. So you can see that it's telling me average ADR of 46.2 pips, right? So I took this trade at the New York Open around 12:1, around 12. So this was where I took the trade. Now at the point where I took the trade around this level here. Let me mark that out also. So at the point where I took this trade, remember the average daily range for Euro USD on this particular day is what? 46.2 pips. So that means before taking this trade, I have to measure from here to here and see how many pips it has moved. So if I take my measuring tool and measure from here to this level, because I entered the setup around, or I entered the trade around here, which was around 12 p.m. My time. So I have to measure how many pips it has moved before my time of entry. So if I'm taking it from this new day starts, measuring it from the high to the low before my entry was taken, that means price moved 21 pips, which is around 30 towards 50%, which that is what we want to see. Remember the rules I give. If price has moved 30 to 50%, that is a good sign. That is a go ahead. You can take setups on that particular asset. But if price has moved 70 to 90%, you should be careful taking setups on that particular pair. So for this particular example here, the price has only moved 30 to 50%. It was still around 30 to 50%, which is a go ahead in my book. Now let's delete this. So when I got to, remember, the average daily range for this is 46.2. So if I'm entering here, I will be keeping this in mind that we have already averaged 30 to 40% of or 30 to 50% of this range. So we only have um we only have the remaining 50% to go. That is the remaining 50% of this average daily range to go. So that means I have to lower my expectation of this pair, giving more than what it can give at this point. So what did I do? I took a risk reward ratio of 1 to 1 here. So I got into this area. Let me get my position sizing to short position to here. So I got into price here. My stop loss was around this area, which is this lower high on the 1 hour. Now I'm going for a risk reward of 1 to 1. So that is my normal risk reward ratio actually. And at that point, this is the 1 to 1 here. So you can see I'm still safe because this is the ADR low and this is the ADR high. So I still have enough range to make 1 to 1. Even if I'm going for a risk reward ratio of 1 to 2, you still have enough range to do that because you're looking at the range here. This is the range. This is the because if you measure from here, right, to this ADR low, that should give you the same 46.2 pips. So you can see this ADR low is around 46.2 pips. So you are playing within this range. You still have enough room to get 1 to 2. If you're going for 1 to 3, you still have enough room to make 1 to 3. If you're going for 1 to 4, you can still do that also. So 1 to 4 was around this area here, right, which is around max of the ADR. Now the ADR was maxed out here. So let's say if you're coming into the market and you see that the ADR has already been maxed out, that is, it has completed 7 to 9. It has actually completed 70 to 90% of its daily range, its average daily range. What you need to do is to step back from that, from that setup. You can't enter it anymore because you can't get into the trade anymore because it has already averaged around 70 to 90% of its average what daily range. So as you can see here, after hitting its average daily range, what happened? It started consolidating up until the next day. So that this is a typical example of how to use the ADR. You can see how it helps you frame the average daily range here, and you can see how it gave us the freedom to go for a risk reward ratio of 1 to 1 if you are that kind of trader, 1 to 2, 1 to 3. So this is how you use it to actually set realistic take profit targets because you need to look at the range you are dealing with to see if the price has a probability of giving you that profit target you are going for. So at the end of the day, what you need to know about the ADR is that the ADR tells you how far price usually moves in a day. Don't trade when the ADR is almost exhausted, just like I said here, just like this example here. After the ADR got exhausted, what did you see? You saw consolidation. And also, you need to use the ADR to avoid late entries. That's the same thing I'm actually saying here. Once you see this, once you're already here and you see that the ADR is almost or is maxed out, you don't need to take entries anymore because it's already late. Or let's say you come, you open your charts at, let's say when the price is around, here. Let's say when this candle is actually printing, you can't take any position on this asset anymore because it's already close to its ADR. It has already exhausted 70% to 90% of its average daily range. So there's no need of you to try to play the setup because it's already far gone. It's almost reaches average daily range, which at that point you should stay out of the market in order not to, get into a losing trade or a trade that will then stall and you have to close it with losses. So, guys, if you want to continue learning more trading concept like the one taught here, you can take up our 5 days free training available on our platform. Now, this free training is designed in such a way to guide you through the simple to advanced concepts in trading. So, if you're interested in taking up the 5 day free training, you can click on the link in the description area below. Do not forget to like, subscribe to this channel, and also hit the notification button so you can get notified whenever we upload new educational contents. My name is Emmanuel from Coinlinity. Trade safe, and I'll see you in the next one.